Well, we are finally here. Well, not quite, because it's Sunday and the election is on Tuesday. But we're almost finally here. Make sure, if you haven't voted yet, to get out there and vote. I'm probably going to go with the traditional showing up at the polls on the actual day. Hopefully that's a good decision and not one that causes me to stand in line for 3 or 4 hours. So given that it of course is the election this week, we thought it'd be interesting to talk about some of the investing themes that folks need to be considering over the course of the next 5 years. Interestingly, our themes aren't really politically dependent. No matter what happens sort of on Tuesday, we think that the themes that we're going to talk about on the program today are themes that every investor is going to want to be mindful of, no matter who wins on Tuesday or Wednesday or Thursday or Friday or whenever they know the results. Anyway, we're also going to do a deeper dive on this week's program on the impact of the elimination of the stretch IRA. Talked a little bit about that on the program last week. We really want to kind of do a little bit of a deeper dive. What folks may not realize is that's the single biggest change to how you should be thinking about your accounts, how you should be thinking about your beneficiaries, how you should be thinking about your taxes as it relates to your retirement that we've seen probably in a couple of decades. So certainly necessitates a deeper dive on the Secure Act. And then sadly, we'll share with you another example of the SEC, Securities Exchange Commission, designed its purpose, right, to protect investors. Once again, another example of the SEC sleeping on the job, and wanted to share with you that because if they aren't doing their job, we're going to do our job and make sure that people understand that there are some specific investment products that just this past week, the SEC decided that maybe we don't really need to, kind of warn investors about this stuff. Thanks to, as you might well imagine, some powerful lobbying efforts by the two companies that have the most to bear in terms of the assets in these types of products. So, packed show as always on the program. Welcome, of course. This is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio show, coming to you here on Sunday morning at 9 a.m. on the News Radio Orlando network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web, with, at last count, over 13,000 downloads of our program. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So last week we talked about the COLA adjustment for Social Security. Pretty minimal, if you recall, about 1.3%. Yet to be determined is the amount of the Medicare increase, which could suck up all of that increase in the higher cost of Medicare. That piece hasn't been adjusted, but the importance of that COLA at 1.3%, it really does sort of ripple through a lot of other places that you may not initially think of. Everybody thinks of the COLA of, okay, that means I'm going to get a little bit more Social Security. Well, it also changes things in the tax code and as it relates to your retirement. And the IRS recently announced those types of adjustments that are going to occur as a result of that COLA increase. Now, obviously 1.3, we're not talking about dramatic adjustments, but there are some areas where you're going to see some numbers adjust that you certainly want to be aware of. More so on the tax side of things. So if we kind of break this into sort of two parts, retirement-related matters and taxes and tax-related matters, the cost of living adjustment probably has greater impact on the tax side of things, because at the end of the day, on the retirement account side, with a 1.3% increase, it effectively translated to no real change in the amount of money that you could put into your 401k, your 403b, or your deferred comp for the year 2021. That maximum contribution limit is going to stay at $19,500. If you're over age 50, you get to put in an extra $6,500 on top of that. So maximum limit over age 50 is $26,000. And that's not a change from the year 2020. Similarly, with IRAs, Roths, the amount that you can contribute there, $6,000. If you're over 50, it's an extra catch-up of $1,000, so $7,000. Those limits also did not change again because the COLA was so low. The real concern, that these limits have is that there was some speculation that because of such low numbers of inflation that you could actually have seen them kind of peel down a little bit. So fortunately, they did not go down and go up either, but at the very least, they remain the same. So the reality is that 12% of the people out there maximize out the 19,000 number, and only 15% of Americans over age 50 max out the catch-up contribution. So again, looking at those numbers, this is where we're going to serve as a reminder to make sure that you're doing all that you can to save for your retirement, because the maximum limits are much higher than people realize. Certainly the ability, if you're over age 50, to put away $26,000 into your employer's 401k, that's a pretty significant and substantial number. Not many people do. More people probably should hit those maximums. Certainly there's room to increase those contributions because the vast majority of people are not hitting those maximum limits. About the only thing that did increase in terms of the amount that you could contribute was the aggregate amount that you could do to an employer-sponsored plan. Those numbers increased from 57,000 up to 58,000. So in terms of numbers that changed in terms of aggregate limits, that one that has to deal with employer-sponsored plans was the only one that increased by about $1,000. The income contribution limits did increase a little bit in terms of being able to fund a Roth for a single person. That income limitation where it starts to phase out is at $125,000 now. If you're married filing joint, it's $198,000. Remember though, you can still do the backdoor Roth if you are not eligible for it. What that means is that you can do a IRA that is a non-deductible IRA and then immediately convert it over to a Roth. We're going to talk a little bit more about that later in the program, because that's a little bit of a unique trick that you can do, that you can in essence get a Roth even though your income may not be make you eligible for it. If your income is over those thresholds, then you're not eligible for it. So bottom line of that, be sure to fund your retirement, your employer provided account, even if you can't do the max. At the very least, do as much as you can. And most importantly, don't stop if there is market volatility. On the tax side of things, standard deduction went up by about $150. Married filing joint, that standard deduction went up by about $300. So the married filing joint return standard deduction is now about $25,100. So those are the inflation adjustments that we saw in the retirement side of things, and also on the tax side of things, along with some adjustments on the income tax brackets as well. So certainly that COLA change rippled beyond just Social Security to affect retirement accounts and your taxes as well. So we're going to take a break. When we get back from the break, we're going to start talking about those investment themes for the next 5 years. All that and more when we get back here on Dollars and Cents with Joel Garris of Nelson Financial Plan. So let's talk about the next 5 years, shall we? Obviously, the election's on Tuesday, and that's what everybody's focusing on, but we're going to take a step back and say, okay, well, what are some of the investment themes that we as investors need to be aware of, particularly as we look out over the next 5 years? And most importantly, what you'll find is that the themes that we're going to talk about really are sort of independent of what happens on Tuesday. Not to burst everybody's bubble, I know everybody's fired up about the election, but history tells us that there's no one direction that the markets go, or there's no one direction that the policies go based upon political parties. We've certainly seen situations where the Democrats have lowered taxes, Republicans have raised taxes, Republicans lower taxes, Democrats raise taxes. You'll hear later on in the program about the Secure Act being perhaps one of the single biggest tax increases on your retirement accounts that we've seen in decades. Guess what? Passed by a Republican Senate, signed by a Republican president earlier this year. So just be aware before you drop to too many generalizations or conclusions about what may or may not happen on Tuesday. There are certainly some broader themes that every investor should consider. So we'll talk about that on the program. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, also one of the top 25 financial planning podcasts on the World Wide Web. If you're interested in connecting to us through social media on the podcast side of things, well, that's very easy. Just search for Nelson Financial Planning or Dollars and Cents with Joel Garris on any of your favorite social media channels, and you will find us. If you can't, go to our website, nelsonfinancialplanning.com. Upper right-hand corner, click on the image that looks most familiar to you, and it will automatically connect you to our channel. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning. Our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior results and gives you peace of mind for the future. So there's definitely some themes to consider regardless of sort of what plays out on Tuesday, and certainly we want to consider those, not just those themes, if you will, but sort of what the investment implications are for investors out there. You know, COVID certainly served as an accelerant for some of these themes. Some of these themes are sort of already percolating out there in the economy at large, and certainly the COVID pandemic certainly served as an accelerant if you think about sort of the geopolitical tensions, the global supply chains, and the technological disruptions, the notion of working from home, of e-commerce. I mean, you think of all of that. I mean, those were already trends that were going on out there that this COVID pandemic really has served to dramatically sort of accelerate that. And so, you know, if you think of it from that perspective, all of that sort of leads to sort of our first theme, if you will, and that's this notion of a sort of a retooled global growth, a retooled more of sort of economic picture. And obviously this was a theme that was happening before in terms of the role of technology and its pervasiveness. But what we've observed is that those that were sort of holding out, I guess, or those that were not comfortable, whether it's businesses with people working from home or whether it was folks that really didn't really do much with the internet or didn't really rely on technology and hadn't ordered things online and things like that, all of that really sort of shifted pretty dramatically. I mean, you were forced by baptism, by fire, to get comfortable with this technology. We see this play out nearly every day in the office, maybe less so now that we're 6 months into the pandemic, but when we're doing our video calls with clients, I can hear Margie, our office assistant, you know, kind of almost doing like a little 5-minute IT speech before they get connected to kind of work people through how you need to get connected. So I think that's something where we've all had to, whether we're comfortable or familiar with that kind of technology or not, you had to get familiar with it. So certainly I think that leads to sort of a bit of a retooled economy that really seeks to take much greater advantage of that. And so from an investment perspective, you certainly want to be looking at the sectors of where your portfolio is. We've talked about this on the program before in terms of, hey, you know, travel and leisure, those types of sectors, it's going to take a while for those to kind of come back. The role of technology continues to be even greater in today's society. So understand that sector analysis on your portfolio has to be done. That's one of the most important things to be doing when it comes to looking at your investments today. The next theme is one that you may not have heard of, but I think you're going to start to hear a lot more about it, and it's called MMT. No, that's not a new mixed martial arts fighting league. It actually stands for Modern Monetary Theory. MMT, Modern Monetary Theory. And you're going to hear a lot about this. If you haven't heard it yet, you will, because it's the idea that monetary policy, which is what the Federal Reserve does, should serve as fiscal policy, i.e. what the politicians do, almost like that the federal policy, the monetary policy should serve as the fiscal policy's wallet through printing of money, okay, obviously that's what the Federal Reserve is doing, that enable political leaders to combat recessions. It's one of these things where basically it's an economic theory that sort of justifies what's happening out there. So you've almost got the Fed's, the monetary policy that the Fed set, working hand in hand with the fiscal policy that the government sets. And so it's certainly an economic theory that's been around, and I think you're going to hear more and more about it as the justification of what's happening out there now, right? These stimulus packages that are several $1 trillion ultimately are intended to help get through the economic period of time and the economic damage that has been presented by the COVID pandemic. So again, some concern there, right? I mean, still printing money. I mean, at some point, somebody's got to, pay the bill, if you will, at the end of the night. And I always get worried when new or newer economic theories start to get used to sort of justify things. So, but no MMT, modern monetary theory. You're going to probably hear more about that going forward as sort of a justification in the financial and media guidelines in terms of sort of justifying what's going on out there in the world. Some perspective, of course, if you kind of look at the balance sheet of the Federal Reserve or the European Central Bank or the Bank of Japan, from a historical perspective, if you look at the balance sheet, meaning the amount of debt that's outstanding as a percentage of GDP, as you might well imagine, it has certainly gone up quite a bit. In 2007, Federal Reserve balance sheet as a percentage of GDP was at 6%. 2019, pre-pandemic, it was at 19%. 2020, right now, it's up to 33%. If you think that's bad, don't worry, the numbers are much greater over in Europe and Japan. ECB, those same numbers, the balance sheet, if you will, by the ECB, European Central Bank, sort of the Federal Reserve of Europe, 16% as a percentage of GDP in the year 2007, 39% pre-pandemic, 53% now in 2020. So you can see where those numbers, Japan, it's much, much worse. 118% is the balance sheet as a percentage of its GDP in the year 2020. So you can see where the Federal Reserves and the equivalents around the world have really increased the amount of borrowing. Again, justification, MMT, modern monetary theory. We'll see how that all plays out. The big caveat, of course, low inflation. So those are a couple of the themes when we get back, we're going to continue sort of the next three themes here that we think investors really need to be on the lookout for in the next 5 years. All that and more coming up on Dollars and Cents with Joel Garris. On the program this week about some of the investment themes that people need to be aware of over the course of the next 5 years, irrespective of sort of what happens on Tuesday in the election. We think that these themes are going to be some of the more important things for investors to consider when they look at their investment mix and when they look at their portfolio and sort of what's going on overall in the economy. So welcome back to the program here, Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning. Our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan that provides superior results along with peace of mind for the future. So talked about a couple of the themes in the last segment. Just to recap, theme number one, sort of a retooled global economy that is going to be much more reliant upon technology if it wasn't already. And then the second is this economic theory called modern monetary theory that basically says, hey, the monetary policies that's set by the Federal Reserve or the equivalent European Central Bank or Bank of Japan really does serve as sort of the fiscal policy, which is what the folks in Washington, the politicians, do, to try and work more closely together to ultimately stem economic problems. We're certainly seeing that play out pretty dramatically, particularly with some of the numbers we gave before at the end of the last segment that talked about how big the Federal Reserve and equivalent balance sheets are as a percentage of GDP in today's world, which leads us sort of to the next theme to be aware of, and that is, if you got all this money floating around out there, what about inflation? So right now there's a lack of inflation, but there's trillions that have been pumped into the system. It's certainly going to take a while for consumer demand to sort of get back on track, but ultimately you certainly could have all of that money in the system help to drive inflation. So the implications on that are that inflation is low for now, but it certainly could go up. As an investor, what you need to know there is that if you're holding a huge chunk in cash or a huge chunk in bonds, unfortunately that portion of your portfolio really isn't going to be doing a whole lot. So important to really look at that mix of, okay, not just in your investment portfolio, but really take a step back and look at your overall picture, your overall wealth picture, what you own and what you owe, because that can be much more instructive than just purely looking at, okay, here's the invested part. So by that I mean, if you've got a bunch of real estate that doesn't have mortgages on it, then I often think of that as sort of a bond or bond equivalent, if you will. So it's so important to kind of take a step back and kind of look at everything that you own and really help to drive what that investment mix might look like. So go beyond just looking at the investment portfolio and saying, okay, this much in stocks, this much in bonds, but really look at, okay, well, how much cash do I have in the banks? How much cash do I have in money markets or CDs? What do I have in other assets? And really take a full look at that picture, because this notion of low inflation is really undermining the impact of being able to get much return when it comes to cash or on the bond side of things. Next up, in terms of sort of these themes, is this notion of globalization. I think this one is sort of a continuation of the theme of US versus China that has obviously been more of an issue of late. I think that issue is not going to go away, and I think that issue is one that will be with us regardless of what happens on Tuesday. The reality is you sort of have to understand the dynamic, all right? I mean, China has 4 times the population of the US as a percent of the global population. So China's population as a percent of the global population is a little over 18%. Ours here in America is a little over 4%. So pretty big spread in terms of the percentage of global population. But here's the thing that is far more important than the number of people, and that is the amount of dollars, if you will, that the U.S. represents in terms of foreign transactions. I mean, when you hear people say the U.S. dollar is the world's reserve currency, that's really incredibly true, and not just true by a little bit, it's by a whole lot. And so here's the numbers. If you look at as a percentage of foreign exchange trading volume, US dollar accounts for over 44% of that. The Chinese yuan, on the other hand, just a little over 2%. That's a pretty big gap, and one that at the end of the day still carries an awful lot of weight in terms of the economic system. So understand that theme of US and China. Yes, they've got a bigger population. Yes, their economy is growing at a faster rate than ours, of course, but our economy is still larger by about 50%. And at the end of the day, we still have a substantial advantage in terms of the reserve currency or the place as the reserve currency. What the implications are from an investment perspective is that I do see that those global supply chains may not be as broad as they were, right? Pre-pandemic, it was fine to have, stuff coming from China. The reality is, I think that because of the seize up of the flow of trade, and not just because of the trade issues with China, but just the pandemic shutting down those flows, that a lot of industries realized, hey, we probably want to have at least some of the manufacturing a little bit closer to home, so that when these types of things happen, then there's not that big disruption. So as an investor, one of the things that you should be thinking about is, well, what investments do I own that are really reliant on cheap labor from China? Because the reality is that they may not be as comfortable using that cheap labor for a variety of reasons these days. And so if they bring it back and they have to pay more, then that may erode a little bit of the profit margin for those companies. So you may want to review kind of what it looks like from a company's use of cheap labor in China, and ultimately the fact that some of that, or a lot of that, may very well be going away for that particular company. So that's certainly got some implications on that. Meanwhile, there could be some benefits to companies that specialize more in manufacturing here in the US. So certainly some interesting things to be thinking about when we think about perhaps that potential theme of less globalization, if you will, in terms of the world's economy. And then, lastly, I think there's this notion that is not going away, that's sort of almost like a different flavor of the traditional capitalism that we've all sort of grown up with. And it's more focused sort of on those social issues, whether that be diversity, whether that be sustainability, climate change, income inequality. COVID certainly sort of exacerbated that and really sort of shone a light on that, particularly when you look at the income quartiles, where if you're in the top income quartile in today's world, you are much more likely to be able to be successfully working from home on a laptop than if you are in the bottom quartile. In fact, the numbers are pretty dramatic. It's about 62% of the folks in the top quartile of income in America today have the ability to work easily from home in a laptop. Meanwhile, if you look in the bottom quartile, only about 9%. That's a pretty big spread, and that is one that's certainly exacerbating that income inequality in America. So, I think we're going to see more emphasis on what a company does beyond just sort of maximizing profit. The notion of being a good corporate citizen, I think, is going to become even more so, even more important. And ultimately, that does have an impact. And so I think there's certainly some things to be thinking about in terms of these investment themes. So we're going to slide to a break, and when we come back from the break, we're going to sort of wrap up this part of the conversation, and then we will shift gears. We'll talk about where the SEC fell asleep at the switch once again for investors. All that and more on Dollars and Cents. So on the program today, we thought it would be kind of neat to talk about some of the investment themes that we see are going to play out over the course of the next 5 years, and what the investment implications are for investors. And so in the past couple of segments, we've talked about a lot of those themes, the notion of a retooled sort of global economy that is much more reliant and dependent upon technology. Certainly that was a trend that was continuing, and certainly one we expect to continue. The modern monetary theory, this notion that the Federal Reserve and the folks in government working ultimately together to help navigate through tough economic times. Inflation, I think, continues to stay low. That's got an impact on the return on cash and bonds and things like that, but also the potential to rise as well. Once again, emphasizing the need that if you're a retiree, you've got to also make sure that there's some growth to combat the effects of potential inflation and, of course, taxes as well. Perhaps less globalization, particularly when you think about supply chains and companies that are looking to kind of bring that back. And then we were talking about this notion of maybe a different flavor, if you will, of capitalism, one that is focused more or brings into account more issues of income inequality, social justice, climate change, all of those kinds of issues that I think corporations are going to be called upon to be better corporate citizens, if you will, than what they may have been in the past. And so if you think of it, if you think of it this way, the typical company has changed, right? It used to be that it was manufacturing, required a lot of capital in money in order to build plants and factories and things like that. And now it's with technology, you just don't have to have as many employees or capital expenditures. You don't need a big giant manufacturing plant if you're Netflix, right? I mean, you can see that in the numbers. Intel, which obviously makes computer chips, so that would be manufacturing something, employs 110,000 people. Meanwhile, Netflix employs just over 8,500 people. Both of those companies have basically the same market cap, but one employs a lot more versus the other, which doesn't. So again, I think there's certainly been this notion out there that if you're a company that's run by good, decent people who do the right thing, ultimately, I think you're going to be a better company anyway. I think there's going to be a greater focus on that, if you will. I think there already was a direct correlation to that, personally. Well-run companies are run by good people, good human beings. But I do think that more and more investors are going to want to look at just making sure that it's good human beings that are, in fact, running those companies. So certainly, some things that folks need to be aware of and looking at, and from an investment perspective, really kind of think about those types of things when you think about your portfolio and your investment mix. Speaking of your portfolio, boy, the old SEC once again failing investors, and this one's pretty tough to swallow. Of course, the SEC is in the role, right, is to protect investors, and it's really unbelievable how much they are subject to the whims of the industry rather than, in fact, protecting investors, which is what they're supposed to do. So we got a story on that one, something that actually just played out this past week. Welcome, of course, back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior results and provides you with peace of mind for the future. So the Securities Exchange Commission tasks, obviously, first and foremost with investor protection. And again, it happened just this past week, where all too often it gets sort of swayed by the industry. And so what was shelved this past week by the SEC was a measure to protect investors who buy, sell, own, trade a certain type of electronic exchange traded fund, ETF, that is frankly widely considered to be quite risky. So the product at issue is a type of ETF. This isn't a globalization or general comment on ETFs as a whole. This is a very specific type of ETF that's referred to as a leveraged or inverse ETF. And all told, there's about 33 billion and change in this particular product, so not an insignificant amount of money. Here's how they work. A leveraged ETF or an inverse ETF, however it's just been described or marketed or sold, uses debt, leverage, right? That's another word for debt. It's a fancy word for debt, to ultimately accelerate the performance of an underlying index. So let's say you've got an inverse S&P 500 ETF, right? So it looks at the index and how that's doing, and then because it's borrowing a bunch of money, it ultimately doubles or triples what is going on in that underlying index. All fine and dandy when the market's going up. When the market goes down, that's a whole different ball game. So the point of the proposed rule in front of the SEC was simply to vet the people that are going to be buying this a little bit more thoroughly. It wasn't imposing some big giant restriction. It was just simply looking at the people that are buying this and maybe saying, hey, you've got, you're making, $50,000 a year and you got 10,000 in the bank and that's all. Maybe you shouldn't be buying this kind of an incredibly risky type of investment product. Just baseline stuff for the brokerage industry and the investment advisory industry that claim to, all be acting as fiduciaries. To have these products out there in the first place, I think is a whole nother question. But the reality is they're out there. The SEC simply saying, hey, maybe maybe you should just kind of check in with people a little bit more. But oh no. Okay, that's not how it played out. What's even crazy, here's the crazy part about this, because all this happened this past Wednesday. So shortly before the vote on Wednesday where they said, we're just going to shelve it, the SEC chair and 3 other SEC officials issued a statement that said, we're concerned about investor protection when it comes to these specific types of products, these inverse or leverage ETFs. And compared them similarly to things like exchange traded notes or commodity pools. And so the range of the products out there for investors has really increased. And all that the rule was asking was just check out these people more before letting them simply just buy these products. But guess what? That's not what happened. Despite earlier expressing concern on that same day. Why didn't it happen? Because the 2 main companies that offer these products, ProShares and Direction, told the SEC that such regulation of these sales practices would simply vet people would be a threat to their business model. Harmful and unnecessary restrictions, and it was backed by no less than a 300-page legal memo and no less than 9 conversations and trips between lobbyists and the industry and the SEC between the months of March and July. Unfortunately, bad actions by the SEC, not looking out for investor protections and leaning too much on the industry. The reality is, buyer beware. If you don't understand what it is that you're buying, don't buy it. With that, we'll wrap it on up and get on out of here. Have a good week and be sure to vote on Tuesday if you haven't already. This is Dollars and Cents with Joel Garris.